The business world mourns Jack Welch today. His family announced the 84-year-old former GE chairman and CEO died at the age of 84. Now, under Welch's 2 decades of leadership, GE's market value rose from $12 billion to $410 billion, at one point making it the world's most valuable company. Joining us to discuss his legacy is JPMorgan Analyst Steve Tusa. Steve, thank you for being here. You know, one of his legacies was the investment or the creation of GE Financials and GE Finance. I mean, at one point, there was a huge portion of revenue, but some people might say it was also a kind of the Achilles heel of what had been a worldwide conglomerate.
Yeah, thanks for having me. First of all, obviously our condolences to Jack's friends and families. I didn't really overlap. I started JPMorgan in 1998. Was a junior guy, so I didn't really have much interaction with Jack. But obviously, an absolute legend, and the value that he created from a stock market perspective as his time in the seat as CEO is eye-popping and something to behold. So you got to look back and give credit to the man in his time, and we certainly do that today and reflect on that. So tremendous job over that time period. The building of GE Capital obviously was a big initiative under Jack. Over time, it probably morphed into something that was a little bit beyond what he had envisioned. And certainly there were opportunities before the financial crisis, after Jack left the company as CEO, to de-risk it in what was clearly a different time. The late 2006, 2007, 2008 was a very different time period than the late 90s. When you're in the seat, you do the best job you can, and I think it's up to the next guy to kind of assess the situation and then address whatever problems there are accordingly. And clearly, since then, they've had their challenges.
Yes, indeed they have, and I want to turn to that, Steve, because entirely separately from the news about Jack Welch today, you changed your recommendation on the stock. You'd been a longtime bear, an underweight going back to April of 2019, and now you have upgraded it to neutral and said, our call was not necessarily correct. That said, as you point out, GE still has a lot of challenges. What does it need to continue to do to turn things around?
Yeah, I mean, first of all, we were, I think I used the term wrong. We were wrong. It's okay to use that term as opposed to not correct. We were expecting free cash flow this year to be zero. It ended up coming in at $2.3 billion. That's a big beat. That's important because that's a base for growth to the out years, which, are really the anchor for this story. And so, when they beat you by $2 billion and you end up raising your number by 30% for 2021, which is the anchor for the stock, you really have to take a step back and reevaluate, and that's essentially what we're doing by stepping to the sidelines. Now, that being said, the amount of cash that we have them generating and the amount of earnings we have them generating in 2021 doesn't support a stock price of $14 to $15, which is where most of the bull case targets are, let alone kind of the $11 that's trading today. So we're stopping well short of saying it's a buy here. What do they need to do? I mean, I think it's a challenge for them because in our view, 60% of the portfolio is structurally challenged for growth. And ultimately, if you're not growing and your markets aren't expanding, it's very hard to drive margin improvement, profits, and ultimately cash. I think they're doing what they need to be doing, which is generating a lot more cash in the near term. But to the extent that that doesn't multiply in the next couple of years, which is very hard to do just operating the business, we just don't see more than kind of an $8 stock prices, which is where our price target is. But they did a great job generating cash this year, and we have to acknowledge that. That kind of removes the concerns around the balance sheet, if you will,
right.
And makes it more about what they can earn in the future, which is a key first step.
Stephen, Brian Sazza here. I know you're very plugged into the GE scene. Do you get the sense that Larry Culp is changing the culture at GE?
I've seen a myriad of management changes. The new CEO starts actually today. A CFO starts today. So they have a whole new investor relations team. I do see some fresh blood being infused here. I think to change, this is a business where, especially in kind of the big ticket aviation and power businesses, where you're buying components, you're assembling them, you're negotiating prices, long-term contracts. This is all about kind of managing risk. And investing for the long term. I'm just not sure what culture can do in the near term, but I think he's doing as much as he can while he's kind of juggling these other issues, first and foremost, generating cash and fixing the balance sheet. So I think that cultural change is slow going, but I don't think anybody expects it to be leaps and bounds in the near term. That's something that will play out over the next probably 3 to 5 years, maybe even a decade.
Right.
All right, JPMorgan Analyst Steve Tusa, thank you for joining us on The Move.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.